Hi, and welcome to our first ever live freight market update. Thank you so much for tuning in today. I'm Kelly Lynch, Senior Marketing Specialist here at World Group, and I'll be your host. We've got a great lineup of speakers here today. First, we have Rob Handfield, Bank of America Distinguished Professor at North Carolina State University. Rob will give an update on the situations happening in the Panama and Suez Canal. Rob's a supply chain expert, having authored several books and articles on the subject, and he has a wealth of supply chain resources to share. Next up is John Min, Chief Economist and Managing Director at Monex USA. John will give an update on the U.S. economic outlook for 2024. John has over 20 years of experience in the financial services industry, helping clients manage their foreign exchange risks. Be sure to stick around for his data and insights. And last, but certainly not least, our very own Martin Karczewski, VP of 3PL Services here at UWL, will wrap things up and share some insights that shippers need to know as y'all plan for 2024. We had some slight audio issues in the beginning of the webinar, so apologies, but we are missing the first minute of Rob's presentation, so I'm just going to go ahead and give a quick recap of what he talked about, and then we'll jump right in where it picks up. One of the first things that Rob addressed is how the Panama Canal and the Suez Canal are not the only choke points that we're keeping an eye on in 2024. The Bab el-Mandeb and the Strait of Hormuz are two additional areas that we'll be looking at because these areas are very key to oil and gas, and if anything happens in these areas to gum up the works, it could also impact shipping. Another one to keep an eye on is the Cape of Good Hope, especially because all of the traffic that was once going through the Suez Canal, majority of it is routed through the Cape of Good Hope now. So this is another area that could cause problems should anything happen. But for today's talk, we're primarily focused on the Panama Canal and the Suez Canal. The first canal we'll look at today is the Panama Canal, which is currently experiencing a drought situation that has limited the number of ships that can transit it each day. If you're unfamiliar with how the Panama Canal works, there's a series of locks that the ships need to pass through to make it from one side to the other. These locks are fed by the freshwater lake, Lake Gatun. It actually takes around 52 million gallons of water, or 200 million liters of water, for one ship to pass through the canal. So you can imagine the impact that a drought would have on the operational efficiency of it. The Panama Canal Authority has employed some innovative strategies to try to recycle the water, but unfortunately, a lot of it still ends up being dumped back into the ocean and it cannot be reused. The water in Lake Gatun is typically replenished by rainfall. So if there's no rain, there's not enough water for the ships to get through. When droughts happen in Panama, the Panama Canal Authority typically implements draft restrictions, which limit the size of the vessels that can pass through them. When these draft restrictions occur, sometimes the ocean carriers will also limit container weights, or they'll sail light and not carry as much cargo through the canal as usual.
Those lakes also feed a lot of the water supply for Panama, so there's also restrictions on water in Panama, and it's also impacting the amount of revenue that the government gets, which is 5 to 6% of Panama's GDP is tied to canal volume. So there's some significant challenges there for the country. Next, please. So that capacity is down about 35%, which, as you can see here, is significant. This is one of the things that's happened is as the number of ships going through is restricted, you're starting to see Panama beginning to find alternate ways to increase revenue. And this is, of course, creating a queue of ships waiting to get through. And in some cases, what's happening is there's now a kind of an auction that takes place to allow ships to go through the canal. And some carriers are paying as much as $400,000 or up to $2 million to be able to get moved up in the queue. So it's created a bit of a bidding war to get ships through. And this has kind of left a lot of the carriers with kind of an expensive calculus. You can either sit and have your ship wait in line. You can pay a significant amount of money to move up in the queue, or you can choose to send your ship around uh, the Cape Horn, around the southern tip of South America, which is also very expensive. Now, Panama has basically about 5% of global freight, so that is a significant amount. The countries that are most impacted, and we can go to the next slide, are countries in the South American region. And you can see here that those countries include Guatemala, Ecuador, Chile, Panama, Peru, etc. So there is a significant impact, especially on these South American countries. The drought, they're saying, is attributable to the El Nino weather phenomenon and climate change. And Panama realizes that this is problematic. Some of the people that are involved in climate change studies say that these kinds of droughts are relatively few and far between. However, three of them have occurred in Panama in the last 25 years. So this is something that we may see more of in the future. Um, there's hope that in May, which is the rainy season in Panama, Panama receives more rain than any other country in the world. Will hopefully, fill up those lakes and cause an end to the drought. But it is something to keep an eye on, and these droughts are something that are becoming more and more frequent, and it could be problematic. Uh, Canal authorities are also looking at alternatives to try to fill up the lake, with additional investments. But again, some of those investments won't come through until 2025 or 2026. The other big choke point at the moment is the Suez Canal, and this is being driven, of course, by conflict in the Middle East. And you can see, the geopolitical tensions in this area is impacting not just the Suez Canal, but other regions in the Middle East as well. And a lot of this is attributable to Iran, firing missiles into Iraq and Syria, and funding some of these militia attacks. The big attacks, of course, that impact shipping are in the Red Sea from the Houthi rebels. These Houthi rebels are, for the most part, targeting Western ships while allowing Chinese and Russian ships to go through. So it's definitely a geopolitical conflict that's taking place. You can see where these attacks have taken place. There was a story in the Wall Street Journal this morning about the Rubaiyat, which is a Lebanese ship that was attacked, and it's slowly sinking into the ocean. And it has large volumes of fertilizer, which, if dumped into the ocean, could really create a hazardous, toxic situation there for residents in that area. So this is a very dangerous place to go right now. And as a result, almost all of the major ocean carriers are rerouting their ships around the Cape of Good Hope. They're just not willing to take the risk. And so shipping costs, of course, are on the rise. The Suez has about 15% of world shipping traffic, much more than the Panama, but up to 30% of global container trade. And the Suez is impacting really Europe the most. And we've seen shipping rates from Asia into Europe go up by about 150%. Ship traffic through this region has tumbled as well. And we're seeing ongoing issues with the Houthi rebels that are not able to do this. So we're seeing the traffic plummet. Um, the routing ships around Africa increases the journey's length by about 2.5 weeks, but it also again reduces the capacity of these ships, so by about 25%. So this is pushing up the price of shipping, and we're seeing those rates go up significantly. Carriers are also announcing surcharges ranging from $500 to as much as $2,700 per container. So this is not a great situation. Oil prices have also jumped because there's a lot of oil that travels through the Suez. And we're also seeing, even things like automotive parts. So we've had shutdowns in Germany for some of the automotive manufacturers because of a lack of parts. And this is a real problem. And in terms of the overall cost, next one, please. We did some sort of back of the napkin analysis, and it is true that both of these routes handle a significant amount of container traffic. Some of the analysis we did is that really transportation cost as a percentage of many of the typical goods that you see is roughly 1 to 3%. So it's not making a huge impact yet on finished products. Um, Insurance costs for these carriers is also going up. Again, however, insurance and freight relative to customs import value is below 5% for the majority of products. So we are going to see some increases in overall product costs, not likely to be significant, but definitely is going up more than in the past. Next, please. Some of the big big takeaways that I want to kind of conclude with. Uh, Lead times are definitely increasing. So we're seeing the length of time on the water go up as carriers are having to divert their routes around the Cape of Good Hope and Cape Horn. The fuel surcharges are also impacting containers, especially those going through the Suez. But one of the other impacts that people don't talk about is working capital. As those lead times are extended, you have more and more products sitting on carriers in the ocean as the time on the water goes up. And that's a factor that often people don't think about, but is certainly an issue as these risks go on. The Panama carriers, again, you have very few options. Risk waiting for days, paying a big fee to jump the line or take the longer route. People are kind of crossing their fingers, hoping that there'll be a lot of rain in May, and that this hopefully will address the situation. The Suez Canal, this is an ongoing problem, and I know U.S. forces have gone in and have actually tried to take down. The attacks are through missiles, they're through drones. The U.S. actually boarded a ship recently that was bound for Yemen, that was carrying missiles that were coming from Iran. So we know that Iran is really behind a lot of these, and it's really in punishment for the Israeli attack and the support of the West for Israel to some extent. Again, hopefully, some of the rains will come in. Hopefully, there'll be maybe some UN intervention in the Red Sea to help address these issues. But these are really rogue activities that are very difficult to predict and control. Uh, weather issues, of course, are almost impossible to predict. And so, we have some real issues in terms of challenges ahead. And again, I don't think this is going to significantly impact uh, a lot of the end product costs, but it definitely will impact our shipping costs if you're involved in carrier or import, export, or freight forwarding. Any questions?
Looks like we got a couple of questions. So the first one is the queue auction payment separate from the ships that have reservations or all encompassing?
Yes, that's a great question. I'm not intimately familiar if whether the queuing uh, auctions are separate from the reservation system. I that I'm not familiar with how that calculus works out. I expect that if you are you don't have a reservation and you pay the additional fee, you may well be pushed ahead of a reservation. But if you have a reservation, you may be able to keep that. So That's a great question. I'll have to look into that further, but I can't answer it sitting here today. If you have insight, please share it.
Another question that came in was around the surplus of new ships coming on and if that will impact or help mitigate the extra time to go around the Cape.
Another great question. Yeah, we're seeing, during COVID, there was a huge investment in new carriers being constructed, particularly out of China. The Chinese have been producing new ships at an astonishing rate. And, there is a lot of extra capacity on the market right now. And so, that's another countervailing force that's pushing shipping rates down is all of that extra capacity coming onto the market. So there's, yeah, there is a good, angle to take away from this as well is that uh, possibly the rates may not go up as much as anticipated as these new ships come onto the market and new carrier capacity becomes available. So I would say there's there may be some relief in sight here within the next year or so on as that capacity becomes available. And this is a link to my blog, and if you have further questions, of course, be happy to have a discussion with anyone out there.
Yes, and thank you everyone for submitting your questions. There's a few more that are more specific, so we'll definitely get back to you on some of those. So thank you so much, Rob, for your insights on the canal. If you guys want to connect with Rob, we'll share this presentation after. There's a link to his LinkedIn page, and definitely check out his blog, or you can email him as well. Up next, we've got
Thank you
John
so
Min.
much for the.
Thank you very much, Kelly. Before I jump into my forecast for this year, next slide. I do want to congratulate our Federal Reserve for doing something I thought it would be more difficult to do, which is reduce the inflation rate that reached up to close to 8% just 18 months ago. According to the last month reading of the personal consumption expenditure, not CPI, down to 2%. That's their explicit mandate. And as of last month, PCE reading was at 3%. And if you look at the red line, it's kind of difficult to see it. There's so many lines, but if you look at the red line, that's the annualized rate of the last 6 months, not the last 12 months. That's well below 3%. And so based on this development, and oh, by the way, we're getting another PCE report for month of January tomorrow, 8:30. We would like to see continued trend march down to 2% at the annualized rate. That would be officially known as soft landing. Next slide. Because the Fed was able to do this without raising economic theory is, and we teach this at grad school, undergrad, even high school AP classes, which is that there's inverse relationship between inflation and unemployment rate. We call this Phillips curve. An idea is that if the Fed wants to reduce inflation, only way they can do it is by raising the unemployment rate. And based on the back of the envelope calculations many of us did about 12 months ago, we had to see the unemployment increase to about 5%. Oh, by the way, what's implied in this calculation is what would trigger the inflation, the unemployment rate from 3.7%, which is near 40-year low, up to 5%. We needed mild recession. No one talked about it, but that was implied within that relationship. But to everyone's amazement, nerdy economist, which is that we brought the inflation rate way down and unemployment rate is still at 3.7%. It's a remarkable. That would be a classic definition of soft landing. The Fed has managed to pull out only once every other. Yep. Now, despite this good news, Kelly, the next slide. consumers are feeling miserable. Now, there are two monthly economic indicators that we use to assess how the consumers are doing in the US. Now, this is very important because US consumers drive 70% of US activity. And one of the monthly survey is known as Consumer Confidence Index, produced by Conference Board out of New York. That's the dark blue line. That's at the range that you see when economy is at a boom. Now, I'm not surprised to see that because that survey tends to focus on employment situation. Do you have a job? Is it easier to get a job? Do you feel secure at your job? Those type of questions. Yeah, with the unemployment rate at 3.7, 40-year low, I'm not surprised to see that index is well above 100. So that's a good sign. But the problem is the light blue survey indicator is down at 80 range. And we have never seen a gap between these two surveys as wide as what we're seeing now, period. Throughout the whole history of measuring this for almost 45, 50 years or so. And University of Michigan produces consumer sentiment. Now they tend to focus on your buying situations. What's it like when you go to groceries? How is your household finances? And that index measure is just at 80, which is usually the level we see when we see a recession. So if you're worried, if you were confused about why economy seems to be doing well, but we feel so miserable, at the end of the day, it's the accumulative effect of inflation. That's the little photograph to the right. I know inflation rate is about 3%, but that still means prices are going up. In the past 2 years, you put all the inflationary effects together. It's almost like you took a nap, woke up 2 years later, and everything around you is 20 to 25% more expensive. And forget about buying a car. You walked up 2 years later and car prices are 33% more expensive. And that's putting a lot of pressure on US consumers. Next slide. And this is happening just as we are running out of excess COVID savings. Now, remember when we had a COVID shutdown, we had a very aggressive fiscal stimulus action, totaling about $5.1 trillion worth of money that Uncle Sam spent to get the economy out of the funk. Out of that, $2.1 trillion were in the form of three checks to the US consumers. So hopefully most of you got those 3 checks, $1,200, $800, $600. They all piled in initially into our savings account. So we call that excess COVID savings, totaling about $2.1 trillion. And for the past year and a half, well, about a year and a half, we've been drawing down from it. And now, according to the Bureau of Economic Analysis, their latest update last month is that we have about $300 billion left over. And we're burning through at a rate of 50 billion a month, which means based on my calculation, we would have spent all that excess COVID savings by April of this year. So timing is not that good. And the next slide. And we're already seeing a related, I won't say phenomenon, but I'm not surprised to see this. Last 3 months, Americans added $150 billion to their credit card balance, which is the fastest increase that quarterly increase we have seen in the last 40 years or so. And as of last week, we set a brand new record. Collectively, we have about $1.1 trillion in credit card debt balance, which is not a good, healthy sign, given that one of the economic indicators I've been tracking for the past 6 months is the 30-day delinquency rate. It's rapidly approaching now. It's past the pre-COVID level. It's at 3% nationally. And if it gets to be at 4.5% that means we're in recession. So yes, consumers are stressed out. They ran out of savings. They're charging things on their credit card. Next slide. And now I'm going to get super nerdy with you guys. We live in a real world. So I don't care what the nominal interest rate is. The real interest rate is what drives the real economy. Now, how do you calculate the real interest rate? You take a nominal interest rate minus inflation. So when even the interest rate was 5% a year and a half ago, inflation was 8%. So in theory, I could borrow at 5%, buy commodities, and let the prices increase by 8%. I'd be better off by 3%. That's a negative interest rate situation. In that type of environment, we encourage more borrowing, more risk taking, especially in investment and things like that. But now we have what's known as a positive real interest rate. The inflation rate is, the interest rate is 5%, the nominal. Inflation is down to 3%. Now we really have to pay real interest rate of 2%. And anytime when you see the real interest rate go up to about 2 to 3% range, we have seen recession in the past, because that means credit is getting very expensive and it's restrictive environment. And therefore, right now, we have growing share of economists, including myself, Fed should be lowering the interest rate to make the credit condition less restrictive. Of course, our Fed is low gun shy. They're data dependent. What that means is they want to make sure we get to 2% before they start lowering the interest rate. So if we were doing webinar about a month ago, I would have said Fed would start lowering the interest rate about March, April. That was the reason why the stock market has really performed well this year, because they were so excited about lower interest rate and better credit condition for businesses. But now, as of today, we think the first cut in interest rate is July, because Fed wants to make sure we can get to 2% before they start lowering it. Meanwhile, remember we talked about a credit card balance. Average interest rate on US credit card is about 24%. I have some undergrads that I was surprised to learn they're maxing out on their credit cards and they're paying 32% interest on it. Now, if we had a negative interest rate, that pain is somewhat mitigated, but now we have a positive real interest rate. So anyone with the debt, like credit card debt, auto debt, student loans, if they're not fixed, then it's going to cause a lot of pain. And that's why I'm a little worried about the commercial real estate, but that's a separate topic. But next slide. Now we're beginning to see cracks in the consumer household finances. I don't want to say this is my favorite economic indicator, but it's my go-to economic indicator because it has been very reliable for me for the past 30 years or so, which is looking at the serious auto loan delinquency rate. Definition of serious is 90 days delay in the auto loan. And one rationale is that we all need cars to go to work, go to school. So we may skip on other payments, but car payments, we're going to make it until it gets to the point of cracking. And right now, if you look at the different age cohorts, you can see that it's at the level of early recession period. By the way, one way you can look at the US consumer base is like a pyramid. You got different income tiers. And whenever there's a crack in the US consumer spending, it starts at the bottom. And you can see that by the younger cohorts. And by definition, younger cohorts, they have, on average, less income, less net wealth to rely on, and they're cracking under pressure. And a lot of us are taking money out of our 401k plan. I'm tracking the graph as well. It's rising for the emergency expenses that may happen during the course of the month. So these are not all good signs about what the situation is for American consumers. So next slide. So the initial takeaway from my presentation right now is that don't rule out a potential recession. By definition, a recession is a contraction, 2 quarters. And if it's going to happen, I think it's going to happen second half of this year. According to the New York Fed, they have one of the most reliable recession predictor, which is based on yield curve and all that. But they think there's a 63% chance still we may see a contraction. And globally, that's already happening in UK. They're technically in recession. Japan went technically into recession this quarter, and Germany is in technical recession. Next one we're predicting is France and Italy. US, we still have a chance. And if you look at the leading economic indicator, that's graph to the right, that's forward-looking economic data, because so far I've been using all the backward-looking data to describe what's happening. When you look at forward-looking economic data, the sentiment is we're already in a recessionary territory. Next slide. But that being the case, our economic forecast, the growth for this year, the GDP real growth is not negative. It's positive. It's kind of in line with the IMF's latest economic forecast, which is US economy will grow roughly about 2% this year. which is down from 2.5% last year because we had a phenomenal back-to-back quarter of GDP growth last year. And if you ask me, John, oh, by the way, for those of you who are involved in international global trades and everything else, the global growth rate, we expect to decline to about 3.1% from about 4% that we usually see globally. So there is a stagnation overall, but the US is a 2% growth. And if you ask me, and if you ask me, John, where's Monex exactly? We're a little bit below that. I think we think it's 1.8%. Not as low as Congressional Budget Office. They think it's going to be 1.5. Most optimistic forecast I see out there by leading banks is Goldman Sachs. They think we will grow about 2.3%. But the bottom line is we'll have a positive growth instead of negative growth based on all these forecasts. So if you ask me, John, you've been telling us for the past 8-9 slides, American consumers are maxed out, they're racking up at the debt, they're under financial pressure. How come can you predicting a growth? And the reason is, next slide, it's because we have real wage gains. Just like the real interest rate is important in the real world, it's not the nominal wage gains, it's the real wage gains. So right now, the wages are growing at 4.5 to 5%, which is much better than 3% that we're used to seeing for the past decade or so. But inflation rate is 3%. So if the wages are going up at 5%, inflation is 3%, we have a real gain of 2%. And most of us have a job. So we're getting paycheck month to month. That will enable us to keep our spending going for the rest of the year. So, and the timing of when we start realizing real wage gains is perfect because consumers were maxing out on their credit card as we speak, and the real wage kicked in. And this is a wonderful news. Now, some of you who says, oh, John, how could this be a real good news? Because if the wages are growing at 4 or 5%, ultimately businesses have to pass on that increase in cost in form of higher prices that will raise the inflation. They may force the Fed to not lower the interest rate at all this year, maybe even raise it, putting additional pressure on consumers, and that could crack the whole non-recessionary forecast. And the real reason we're not calling for recession is, the next slide. This is something I never expected. Our productivity, the amount of stuff that we can produce per hour has jumped. We are used to see about 1.5% gain in productivity, but now we're seeing about 3.2, 3.3%. And just like this young lady here, I got my fingers crossed because the productivity was my dissertation topic back in the day. One thing we know about productivity is they come and they go. And it's mysterious. And right now we're getting the benefits of positive productivity shock. We don't know why, because it takes forever to figure out what's causing this productivity gain. One thing we do know is not AI. It's too early. It's too early. So we're hopeful if the productivity holds, then the businesses, they don't have to pass on higher costs because they're paying higher wages. That's going to allow the inflation to continue to come down. And then we'll have see a growth, we'll gain in wages, and they will keep the growth going. And so our entire forecast for this year is based on productivity holding up for the rest of the year. One little fun fact. We do expect the wages to continue to increase at elevated level because as of last week in the United States, 11,000 people turn 65 every day. And it's going to be like that for the next 6 years, by the way, every day. And they retire in the US because at 65, you qualify for Medicaid. So increasing number of folks are retiring. We actually have a shortage of workers in the United States, and I don't have to explain why because I guess you guys feel it out there. As a result, we do expect the wages to continue. So we need productivity to stay high in order to prevent inflation from reaccelerating. Next slide. In this very precarious economic condition in US is stagnant growth. It won't take that much to push us into a not soft landing, I call it bumpy landing. And one of the area I'm really keeping a focus on, next slide, is related to Rob's earlier presentation. In fact, Oxford Economics, which is a global think tank out of London, they surveyed 2,000 CEOs of the largest companies around the world. And their number one CEO concern for this year is not inflation. Inflation was last year, their number one concern. Number one concern for this year is geopolitical shock. And one of the areas I'm looking at is what's happening in the Middle East related to Suez Canal, because as you can see, it could affect 20% of the global shipping. And then on a side note, if you want to know why there's so much tension between China and US over South China Sea and even the East China Sea, it's not really Taiwan, in my opinion. I mean, computer chips are important, I get it, but it's 50% of the global shipping traffic could be affected, or whoever controls that lane can put a choke on 50% of global shipping. And by volume and by dollar amount, 80 to 90% of global trade is done through global shipping. And this whole concept of freedom of navigation that was guaranteed by US Navy after World War II, when we had 7,000 ships, by the way, that was the foundation for globalization and the emergence of just-in-time supply chain, everything else. You need that freedom of navigation. But now we're down to, well, under Ronald Reagan, we had 600 ships. And then my neighbor is an admiral. And I asked him just the other day when I was walking my dog, how many ships do we have? It's a 290 and number is going lower. I think it's going to be increasingly, the shipping lanes going to become a global geopolitical shock because it doesn't take that much to disturb the shipping lanes. It only takes one drone costing about $3,000 and you can really affect the traffic through the global shipping lanes. Next slide. And the preliminary data, as Rob was saying, because 60% of the Suez Canal traffic is down last month, and it's adding 10 additional days to shipping, especially from Asia to Europe. So Europe is getting more affected by this. Next slide. And we're seeing the rising shipping cost. Cost of shipping one 40-foot container through major shipping lanes is increasing by 100 to 300% as we speak. From Economist point of view, that translates into lower PMI, that's Purchasing Managers Index, the data I look at every single month. It's a survey of the purchasing managers, and now the big concern is slow deliveries, which is affecting all aspects of business. And there's a good chance the situation could get worse, and which means it will show up on PMI data, and it has consequence of, next slide, inflationary pressure. Now we have a very good data from the last 3 years of experience. There's a direct channel, a relationship between rising shipping costs and inflation. And actually, inflation is more affected in Europe than the US because we're less dependent on imports, but we do see it in the data. So the implication is if the geopolitical situation, especially related to global shipping, gets worse, shipping cost increases, it increases delays, it will show up on inflationary data, which means for the US, next slide, we thought we got inflation under control and we're about to celebrate, and that could quickly reverse. So if you see, the graph is a little confusing, but important bar is the gray one, because recent disinflation we have experienced is really due to supply chain normalizing and China coming back online after COVID shutdown. And if the supply chain gets stressed and is imposing higher costs, then we can quickly reaccelerate the inflation, and then all bets are off on our forecast because our bets are based on inflation continue to come down. Next slide. And then, of course, you have another event that I cannot model, is an election. And I really do believe elections do have consequences. And I wish election results were linear, but it's either black and white or 1 or 0. It's a binary event, so I cannot model it. But I am hypersensitive to potential effect of election outcome to the US economy. Next slide. Because back in 2016, soon as Trump administration took over the White House, Mexican peso took a big hit. It went from 17 to 21. And then, of course, a Chinese yuan took a big hit because there are some trade implications there based on different administration. And I do expect after November's election, these two currencies going to be heavily affected. But the next slide. But this time, I think the euro going to be very affected. So right now, we're advising all of our clients, be careful. Second half of this year, euro is going to be very volatile compared to the dollar, because two different administrations may have two different policy stance again when it comes to Ukraine situation, Ukraine and NATO. So be careful with that. Next slide. And of course, tariff issue. Trump administration, if they come to power in November, they're talking about 60% increase in tariffs, not increase, 60% tariff on all goods from China. I don't know whether that's going to happen or not, but based on our very in-depth analysis that we have done, at the end of the day, tariffs are like taxes on U.S. consumers, and the current tariff system we have in place, we think there's a drag on the U.S. economy by 0.2%. If we impose 60% tariff on all Chinese goods, we expect there's a full 100%, 100 basis point or 1% decline in the U.S. That could literally tip us over into recession, because it's the consumers who have to bear, who has to pay for the tariffs. And as I said, consumers are maxed out as we speak. Next slide. And the last one is the fiscal debt. At the end of the day, I think Trump administration added about $7 trillion to our national debt. I think Biden administration, at last account, is up to $3 trillion. So both administrations don't have a good track record managing or maintaining fiscal discipline. I think that's a nice way to say it. The number that I'm looking at very carefully is that little circle on the bottom of that image. That's the interest that we have to pay this year just to finance it. Forget about paying off the principal. One of my students at the university asked me, how much would it cost to pay off the debt? And I said, well, it would cost every American, all 320 million Americans. We have to write a check for $101,000 to help Uncle Sam pay off the debt. So let's not even think about that. Just to pay the interest this year, I am projecting that we're going to spend more money on our interest payments than our entire money we're going to spend on defense this year. That's the first time ever. And if nothing changes, oh, by the way, we have a full employment. We should be having surplus right now, not deficit. So we have a structural deficit. So it doesn't matter what we do, we're going to be having a deficit every year. That's what, according to Congressional Budget Office. According to that forecast, our interest payment is going to be greater than our entire money we spend on defense, Social Security, Medicaid in the next 10 years. So it's not sustainable. I guess that's what I'm trying to say. And we're already factoring that into our model as a fiscal drag on the economy. So as we go in the coming months, there's going to be more and more drag from crowding out effect, because increasingly Uncle Sam has to allocate more resources just to pay the interest, not get the government, not get the fiscal situation in order. One last thing, if we do go into a recession, we're not going to have blank checks again. It's going to be really hard to dig ourselves out of contraction, because we're running out of fiscal room on the public side. Next slide. So my takeaway at the end of the day is it's not going to be a soft landing at all. I think there's too much risk. There's too much risk for shocks that could affect the rosy forecast of smooth landing of inflation coming down to 2%, unemployment staying at 3.5, 3.7%, the economy continue to grow at 2.5, 2.6%. I don't think that's realistic. We are forecasting it's going to be a very bumpy ride, but not a contraction, not recession, but slower growth. 1.8% is the best case I could think of, but there's a good chance we could be well below 1% if any one of these things happen. So be prepared. I guess that's my message today. Thank you so much. Oh, I am ashamed to share this slide with you, but our marketing is watching this webinar, so I have to share it. There are 56 financial institutions. We provide our economic and the currency forecast to Bloomberg every quarter. And if you have a Bloomberg terminal, just go and rank based on economic forecast. Right now we're number 2. We beat out all the big boys and girls around the world. And for the past 2 years, we've been consistently in top 4, top 3. So we're very optimistic. All the credit goes to my team. We have a nice model. They retweaked after the COVID shutdown. That seems to be doing pretty good job in terms of anticipating which way it's going to go. Obviously, we cannot forecast shocks. We call it exogenous shocks, something that just happens just because of one drone got fired, or election outcome. That I cannot predict. But if you are interested, there is a new marketplace called Kalshi. It's regulated by U.S. government. You can see the bets on who's going to win the election. And people are buying and selling those bets. It's like a options market. And right now, it seems like election is too close to call. So I cannot even lean to the left or to the right in terms of economic forecast. One thing I can guarantee is that it's going to be extremely volatile as we get close to November. Next one. I think that's the last slide. Yeah, that's it. And if you need to get in contact with me, that's my email address. You can find me on our company website, and that's LinkedIn.
Awesome. Thank you so much, John. I'll let people, if we have one question that I'll pitch over to you, John. If anyone else has questions, go ahead and submit them in the Slido app. The one question we've got is, it was very interesting to see wages up, and that is good, but disturbing to note that although wages are up, credit card debt and possible loan default is on the rise. Do you have any thoughts on the very quick eroding of wage increases to cost of living?
Yeah, the real wage increases have really started about 6, maybe 9 months ago. And that's only when inflation started coming down, disinflation. So we haven't had the full benefits. Meanwhile, we're living in a world of high, the accumulative effects of high inflation for the past 2.5 years. So if the real wage gains continue for another year and a half, maybe 2 years, and inflation stays at 2%, then I think we're going to begin to feel better. And we can restore our, I guess, the household balances and things like that. But right now, we're still way behind because the whole world is 20 to 25% more important. And we really didn't have a real wage gains for the last 6 months or so. And then, of course, real wage gains are mostly going to the service workers because they have a hard time finding workers. So if you're in the manufacturing and other aspects of the economy, you really haven't seen it because the real gains are coming from the low skill, as we say, low skills, service intensive industries. And main reason is 27 states, they raised the minimum wage this year, January 1st, and that's all showing up in the gains and the wages. So it will get better if everything holds the same. It will get better, but it will take almost 2 years to catch up, given the current rate of real wage gains.
Very good, John. I don't even know how to react to that. Honestly, it was just very impactful stuff. So thank you so much for sharing all that information. And a couple people asked if we would have the slides available after. Yes, we will have the slides and the recording. We'll share with you guys after so you can make sure you didn't miss any important details. And last but not least, we've got Martin to talk about the containerized trade outlook.
Sure. Thank you, Kelly, and thank you, John. So you'll be happy to know that I've got neither the time nor the desire to launch into a UWL sales pitch. So I'm going to stay well clear of that. There were 3 or 4 things that I wanted to bring up as we look into the very near future. So as we're thinking about contracting for 2024 into 25, that didn't get covered either by John or by Robert before him. So I'm not going to read these out, obviously word for word, but the labor negotiation on the East and the Gulf coasts is looming. It expires right now at the end of September. The union versus the folks who they're trying to negotiate with are pretty far apart at this point in terms of what they're looking to achieve as a result of this negotiation. Pretty significantly, the wage demand and the bonuses that have been achieved in previous negotiations by other unions are pretty considerable. But they were also negotiated at a time when steamship lines had much more significant coffers to play with. That's no longer the case, and the financial forecast of a lot of steamship lines is going to be challenging into 24 and beyond. So naturally set up for a pretty awkward, uncomfortable negotiation. The one thing that is different for this negotiation than from others is that the ILA have said they will not allow for an extension. So they're not going to go beyond and allow the current arrangement to continue as they further the negotiation. They're going to stop, and they're going to stop quickly at the end of September. So obviously interesting and super important to pay attention to that. What we're seeing as a result of not only the Suez challenges that Robert spoke about earlier on, but in with the sort of looking into the future and the opportunity for an East Coast strike, we're starting to see more volume move to the West Coast. I think that's a trend that will likely continue throughout the balance of this year. And as everybody that experienced COVID and even more recently the issues that have existed, hammering freight into the West Coast just exposed how fragile both the West Coast terminal and then trying to move containers into modal became. So super important to pay attention to that too. And then finally, this is one that's just sort of being percolated at the moment, but the 2M is dissolving at the end of January of next year. And then somewhat surprisingly, Hapag announced its departure from the alliance, which nobody really saw coming. So now there's going to be a period where carriers are looking to jockey for position. I think there will be some additional disruption in that alliance that has existed now for 10 years, certainly as far as the 2M is concerned. And historically, carriers, as they've had to rearrange, reorganize trade routes and partnerships and strings, they've not done that particularly well or particularly cleanly. So expect that there's going to be a pretty significant amount of disruption there as well. So next slide, Kel. So what does this mean and what are we thinking about? So for us, I don't think that MQC divided by 52 has worked for most businesses for a long, long time, but it's still the way that the industry behaves in terms of contracting, particularly on the steamship line. So knowing that there's a lot of volatility out there, it's just going to put more and more pressure on trying to take your supply chain, take your container count, divide it by 52 weeks, and you've got a smooth flow. It's almost certainly not going to work that way. So we're looking at ways to establish contracting that allows for some flexibility in there. It allows you to move up or move down depending on the period of the year or your particular seasonality. But as you do that, trying to maintain obviously a high level of control and a high level of visibility as you become more complex is super important. So choosing a partner or choosing multiple partners that are able to work well together that allows you to maintain that control and flexibility and obviously visibility is really important. We're also thinking about ways if the capacity that we talked about earlier on does enter the market, which it almost certainly will, that likely is going to have a downward pressure on pricing towards the back end of this year and into 2025. So how do you create a vehicle or a mechanism to be able to attach yourself to that spot rate if it does fall below where the fixed rate end up being signed? Not only how do you do that so that you can realize those gains, but how do you do it in a way that doesn't create disruption in your supply chain, and what tolerances do you build to allow you to access that cheaper market is certainly something that we're looking forward to. And whether that's a shorter term contract, balancing ratios against what you fix versus what you allow to flow is something that I think contracts are certainly going to speak to this year. And then finally, somewhat contrary to spot rate softening, allowing for some type of a peak season surcharge should all the things that we talked about, right? The East Coast and the Gulf ports go into meltdown because of a shutdown. There's the disillusion of the 2M and the drama that will bring will almost certainly lead to peaks periodically throughout the year. And I realize this is somewhat unpopular to say, but if you don't have a vehicle or a mechanism inside of your contract to potentially allow you to pay more during those pivotal periods, may end up leaving you out in the cold a little bit. We experienced that a lot during COVID. We've experienced it a little bit in January and February as we've seen the Suez and the Panama Canal cause the issues that it did. That being sort of the cheapest guy on the boat didn't necessarily buy you what you wanted. So creating a vehicle or a mechanism to be able to have a PSS in there somewhere or a Panama Canal surcharge or whatever that may be There are ways to negotiate around that, whether you cap it, whether you cap the dollar amount or the period of time. But I think simply eliminating it from a contract is probably going to create maybe more risk than it does necessarily solve. So those are the things that we're certainly looking forward to for 24 and into 25. I think we're about pretty much out of time, but because I didn't punish you with a 32 slide PowerPoint, I got 2 shameless plugs. So number one, we'll have a pretty sizable contingent at TPM. We're trying to convince John to get there as well, so hopefully we can drag him around with us. So if you're already on deck to meet a UWL representative, can't wait to meet you. If you don't have anything scheduled with us yet, then by all means reach out and we'll happily try and connect with you. And then along those same lines, we've got Chris Krawcheck, who's our VP of Commercial, attached to our SunChief product, which is targeted primarily at Southeast Asia. Is going to be speaking on Tuesday at 4:20 at TPM. So if you're actually attending the event, then would encourage you to try and sit in on that. We've got a pretty cool product out of there, so it'd be interesting for you to listen to. 1 minute over, Kelly. I did pretty good.
Yeah, good job. Thank you everyone so much for your time. Just to recap, we will be sending the slides and the recording after this event. So if you're looking out for those, just be on the lookout for our email. And if you have any other questions, you can shoot them to marketing@shipuwl.com and we will put you in touch with the correct rep to assist. And yeah, thank you. And we hope that you'll come to the next one. There'll be a little survey that pops up once you exit the webinar. If you could just let us know how we did today, that would be fantastic. Thank you so much and have a great rest of your day, everyone.
Thanks, everyone.